Chapter 4, Risk and Return. Okay, so we're going to go over these concepts of risk and return, look at historical returns, talk about time value of money, risk-free rates, required rates of return, returns on holding periods, and the idea being that we've talked about, or you should have talked about or understand time value of money. That's a key factor in computing returns is this compounding effect, future effect. Money compounds and generates more money through the future. But risk is something that we're going to have to put in relationship to return. And let's see. Okay, so let's just move on. Now, let's just think about risk for a minute. If there was a lava pit, figure a trench going across that had a 5-foot width and 100 feet below would be lava. So if you fall into this pit, you die instantly. You'll die even before you hit the lava. Would you jump over this 5-foot pit for $100,000? I would totally do that. 5 feet is very easy to jump over. I do it all the time. In high school, I was a long jumper, and I could jump. I think I remember jumping over at least 12 feet. Yeah, I could jump 12 feet. I think the Olympic long jumpers can do like 16 feet or something. Anybody here on the track team? Do we have a track team? No one's ever on it if we do. I never see anybody running on campus. We must have one, right? I don't know. Okay, so anybody not do that for $100,000? Would you do it for $10? Okay, so you're risk-seeking. I would hold out for $1 million. If there was $1 million, then I would definitely think about doing that. All right, I'm a little slow today. I'm running out of coffee. Oh, it's worse. Okay, so the components of return. Wait, let me just go back to the scenario. What if it was 10 feet? Would you still do that for $100,000 if the pit was 10 feet across? Okay, some people would still do it. Some people would move up higher. I would say you should move up higher because the risk is greater. Because 10 feet, that's a hard distance to jump from and land and stick that. You may be able to, the best I think a lot of people do, be able to jump and grab onto the ledge on the other side and pull themselves up. But, what if you stumble or you misplace your steps running up to jumping over it? There's some risks here. So I guess if no, you would die pretty quick. You would first probably pass out from the fumes and the noxious gases of the lava, and then die instantly on impact if you weren't dead already. But it's still risky. So I think any sane person would want a significant amount of compensation for attempting that. Just like people in the Olympics take a lot of risk when you're performing a risk. You see some of those skiing jumps. Even that ice skating scares me. Some of those ice skating moves, yeah, they're pretty dangerous. Did you ever see that move in The Cutting Edge where he has the girl and he's didn't see that movie? Yeah, that was scary. That seems real dangerous. Like, he lets go of her head is just all over the ice. A side note is I actually worked with the girl, Moya Kelly, that's in The Cutting Edge, and I worked with her at McDonald's in Bohemia. That's her career before becoming a actress, which, if you don't know her, she hasn't been in too many movies, and she doesn't remember me. I tried on her forum, on her fan page, but no, I'm just kidding. She doesn't have a fan page. Components of return: income and capital gains. So we have two components. Income would be dividends or basically dividends. Capital gains is the difference between the purchase price and the sell price, and that's why we want to buy low and sell high. Or if you're short selling, we want to sell high and buy low. So if you own a stock, you can actually get the dividends. If you sell a stock short, you will not be able to get the dividends because you really don't own it. But the combination of these two will be what we consider our total return. So if you want to calculate your return, say you have the 500 stocks in the S&P 500, your return isn't the return of the S&P 500. It's actually larger because you have to factor in the dividends that most of these S&P 500 stocks pay. And dividends right now are the closest they've been to Treasury bond yields in a long time. I think dividend yields, I'm just going to make up some numbers that sound good. The dividend yields, we'll say, are over 2% for the S&P 500 on average, and the Treasuries are around 3% or maybe 2.5%, so they're pretty close. Now, why return is important is because that's the whole reason why we're investing. We're investing to build wealth, and we're investing specifically to defeat inflation. So that's why Treasury bonds aren't the best investment, because they typically don't beat inflation. So you're not really getting anywhere. If inflation is 3% and you have a 3% return on your money, you have the same amount of money. It has the same purchasing power. If you have your money in a savings account and it earns 0.25% of interest, you're actually doing pretty well, because most of them are like 0.1% of interest. But you're going to be, after a year or so, you're going to have less money than you started with, because of the present value of that money is, if you factor in inflation, it's about the same or less. And in bank accounts, it'll be less. But we do want to keep track of returns so we have an idea of how well our investments are doing and how well they're doing compared to our expectations. So that's one thing as an investor. You have to manage your expectations. And if you expect instant returns and instant success, you're going to be very disappointed, because success in investing often takes years. And a thought-out plan that doesn't occur in a 15-week semester like you're trying to do in the trading simulation. So that's why you shouldn't feel bad. If you don't perform very well in the trading simulation initially, you'll be surprised. If you go back and look at it a year later after the class has ended, it'll still be there. You can look at it, and suddenly you've made a lot of money. Because your ideas were good, they were just a little bit ahead of the time. Even in my portfolio online, you see I have a lot of things sold short, because I've been going over with students how to sell short in my office hours. And I'm just leaving them in short position. I don't care. But you know what? If the stock market turns sour and prices start going down and there's a correction, I'll have the #1 account. Because all you guys are long, which is a great strategy right now, because stocks have done very well the past 10 trading sessions. So you're doing good. George, great strategy. Go long. Although you had a couple short positions. I like to spy on your account. I can get away with that. And once you accept my friend invitation, I can spy on you on Facebook too. So, just kidding. I always felt that if they actually allowed people to see who views their profiles on Facebook, Facebook would be a lot less profitable and a lot less activity on Facebook, because we all go on profiles that we really don't want the other person to know about. Like we'll take her, for example. You're stalking a potential boyfriend, and you want to go on their Facebook and kind of see who is this guy friends with, what's his ex-girlfriends like, because guys are stupid. They leave their pictures up forever. Like, girls are smart about it. They'll take those boyfriends down and sanitize their pictures, but guys will just leave their whole history up, and you can go and check out all their former girlfriends and kind of, even there's probably still friends with them on Facebook. You can email them, say, like, what is this guy really like? I'm thinking of, like, getting involved. Is it worth why did you break up? My friend's wife always checks out her husband's Facebook page, but through his sign-in, so she could see who he's emailing and who he's friending, and he gets in trouble so often for friending girls he knew in high school and stuff. And Facebook. That's why I just play games on it to be safe. I don't do anything else. And I only post. Usually, the only pictures I post are pictures of students, like at graduation. Everybody takes pictures, and they send them to me and they tag me in the picture. So I have a lot of student graduation pictures, which is, And there's a picture on my front page, which is just me standing with about 50 Korean students, because we have a right in front of the Wang Center, the Wang Center, sorry, because it was a class from Korea that came and I taught, and they wanted a picture with me because they respect their educators a lot. And so when people from high school see this picture, they say, where did you go? That looks like a foreign country. And I'm like, because they see the building at least looks like it has Asian design in it. They think I've traveled somewhere, but anyway. Okay, so historical performance provides, they say this phrase a lot. Historical performance does not guarantee future performance. But everybody wants to publish it and highlight it. But they have to make this statement so they don't get in trouble, like they guaranteed some kind of future performance. But for most people, they feel that historical performance does give you a basis for future expectations. So if you invest in a mutual fund that for the past 10 years had a successful year of beating the markets every year for the past 10 years, then you'd probably want to invest in that mutual fund rather than a mutual fund that's lost money every year for the past 10 years. And it's not uncommon for the next year, for the one that lost money to make money and the one that made money to lose money. That's why they're safe, though, because they always print this in all the mutual fund information prospectus, and there's not guaranteed future performance. But when you're looking at expected return, you're thinking about what investment's going to earn you in the future. So you don't really care about what it made for people in the past. You're looking about what's this going to do for me in the future, and you're trying to determine how much you're willing to pay today for that stock as an investment. For example, if we talk about Yelp, I would like to own Yelp. I think it's a great app and website and idea, and I think a lot of people use it, and I find it very useful. However, I'm not willing to pay $100 a share for Yelp. Please email me when it gets down to about $20 a share again. Okay? That would be great. Because I think the value of Yelp should be $20 a share. And to me, the risk of investing in a company like that would be worth it. Because Yelp is only one application away of being outdone. Somebody else comes up with a better idea or format or connectivity, or maybe even Facebook moves into that area and they develop a Facebook app specifically like Yelp, and okay, so key factors in return. So the internal characteristics are really the risk of the investment itself, the management of the issuer, and the issuer's financing. So this would be sort of as far as a new type of financial instrument, we would look at these internal characteristics. The external forces that we can't control that we may want to think about, say we were buying a company in a foreign country. Say we're going to buy Nintendo in Japan. So Nintendo has the Japanese stock market and country has their own different political environment than the U.S. They have their own different and unique business environment and economic environment, as well as their own inflation and deflation. So things that can affect Nintendo inside of Japan, which a significant amount of their sales come from Japan as well as around the world. But there are other forces. What if the Japanese government says that Nintendo can only trade on the Japanese stock markets, and if anybody wants to buy who is not from geographically in Japan, there's a 10% surcharge on the stock, Or there's many things that could happen. Say there's a war between China and Japan. They have a territory dispute over those islands, and there's a war, and then now it's going to significantly affect Nintendo because their home base is threatened by war. There could be, destroy their factories, or, their key workers may have to go into the army, things of that nature. Although, has China and Japan ever fought a war against each other? I'm so glad you said that. If people don't, some people, they don't remember that, even a country like India, they've had a war with China before. And Russia and Japan have had a war. A lot of people I'm glad that they're still teaching that and not forgetting about those things. Not that they matter too much today, because that's old history, old past. You know, I mean, America, United States, and Mexico had a war, and you don't see either country crying about it anymore. No, we don't really. No one remembers it. What was that war? You remember it? All right. I remember the Alamo because I was there and it was horrible. It was hot, smelly. Okay, so if we look at historical returns for different asset classes in different countries, you can see that different countries have different rates of return for their stock market, their bond market, and their inflation rates. And this all affects, that's why investing internationally is riskier, but you can also wind up with a better return. In fact, the United States is usually not the top stock market in returns. Usually some other stock market around the world has a higher percentage of returns on their stocks than the United States. You know, but there's a and today is not too different because there is a lot of emerging market risk out there with currencies being devalued and such that are extreme risk. Okay, so let me just adjust this screen a little bit here. Now, okay. Sorry about that. Time value of money. I'm trying to adjust this overlay a little higher. You know what? There we go. Okay, so time value of money, we've talked about this before. You should understand this basic concept that the money you have today is more valuable than the money you're getting in the future. So if you have $1,000 today, that's worth a lot more than $1,000 5 years from now. When you were born, tuition at Stony Brook may have only been $5,000 a year, tuition, room, and board. Now it's $15,000 or more. So you can see that although tuition goes up faster, much faster than inflation. I think inflation is around 3% on average, while increase in tuition is double digits, maybe 11 to 14% increase. So things get more expensive. So investing is a way to maintain the purchasing power of your money. And that's why any investment you have, you want to make sure it's higher than the rate of inflation. So if you had a choice, say you were working a job, you got a brand new job after school, and I'll say you're going to work at a company, they're going to pay you $60,000. And they give you a choice. Would you like the full $60,000 on the first day of work or the last day of the year? The first day of your year or the last day? Say you start January 1st. Do you want that $60,000 January 1st or on December 31st? Right, because that money is more valuable to you on the first day, and it's going to be worth less a year from now. Or think of it this way: if I had the $60,000, let's say January 1st last year, and I invested that in the stock market, I'd have 30% more at the end of the year by December 31st. So you can make the money work for you while you're working to earn it. So if you're ever given the option, that's why if you're a waiter or a waitress that works on tips, that's a great job because you get a lot of that money, a lot of your salary, you get the day you worked. You don't have to wait 2 weeks. But sometimes that's sometimes for some people, it's difficult to get money every day because it's harder to manage it. You know, has anybody here ever worked as a waiter or a waitress? Okay, so you know what I'm talking about. You get that money every day, but you spend part of it. It doesn't really seem like it accumulates as fast. But it's nice to get it every day. Yeah, I would like to get paid every day, but no one tips the professor. Not that I'd accept any tips, but unless they're stock tips. All right. So, of course, the basic statement here is the present value of the benefits equal or exceed the present value of the costs. And this is basically you just want to make sure that the investment is going to return more to you than what you invest after the discounting effect of inflation. Now, as far as measuring return, we have this formula here that something that you might want to have in front of you during the test. And we're looking at the rate of return, the real rate of return, plus the expected inflation rate, plus the risk premium for your investment, and that equals the required rate of return. So as an investor, you should think about, what is my required rate of return? And you always want to beat the inflation premium. And you always want to have a compensation for the risk you're taking and beat the real rate of return. So we'll go over what these things mean individually in a minute, but the required rate of return is going to be the risk-free rate plus the premium for the investment. So the risk-free rate is basically, we can think of that as a 10-year treasury, is the risk-free rate. It's something I can invest in with zero risk. So if the treasuries are at, say, 3%, and you figure that the risk premium, which is something else you calculate through a different calculation, is 10%, your required rate of return would be 13%. Now, if you take the real rate of return and the expected inflation rate, that's basically the risk-free rate. So if you were to break open the risk-free rate, it's basically the real rate of return plus the expected inflation premium. Together, that's the risk-free rate. Okay. So like I said, the real rate of return is going to be your return minus the inflation rate. So you look at the return on the investment minus whatever the inflation is for the year, and that's going to measure the real rate of return on that investment. So if you have an investment that returns 3% and inflation is 3%, you've really not made anything. So you always want your nominal rate to be higher than the inflation rate. And of course the expected inflation premium is what we expect inflation to be next year. So you need to know what is inflation expected to be next year to help you assess your investments this year. And for a long time, inflation has not been a problem. But in the past, if we travel far into the past, into the 1970s and early 80s, inflation was a huge problem. You know what a certificate of deposit is at the bank? They were paying 12 to 15% return on certificates of deposit at the bank. Bank accounts would pay 5, 6, 7% return on your bank account. That's because inflation was so high, they were raising the interest rates to hopefully combat and shrink the economy so that inflation would go down. And when they did that in the 70s, Paul Volcker did that. It worked. It killed inflation, and then they were later able to lower interest rates, but it also killed the economy. And the government deemed that it was better to be in recession than have high inflation, because they felt no value of having an expanding economy if inflation was expanding faster than the economy, because it was basically robbing everybody of money because you couldn't get a return higher than inflation. All right. So when we talk about the risk-free rate, hold on, I'm just thinking. Okay, so the risk-free rate, if we look at, we described this before. It's basically the rate of return you can get without any risk. And we can usually consider that a treasury. And here they're saying a 3-month U.S. treasury. I guess that's even more risk-free, because the U.S. government has never defaulted on the treasuries and is expected to never default on a treasury. So that's why we can consider it risk-free. Now, to get the risk-free rate, what is in this treasury is going to be the real rate of return plus the expected inflation premium. And together is those two components is what make up the risk-free rate. So the real rate of return is what you're going to make above inflation, and the expected inflation premium together will give you the risk-free rate. So the U.S. Treasury should be, the 3-month U.S. Treasury should be trading above inflation to give you a risk-free rate. Sometimes the way the treasuries fluctuate and the yield curves, sometimes that's not always 100% going to line up that way, but typically it does. Okay. So if we talk risk premium, that's any additional, if it's anything other than a 3-month treasury, we're saying there's additional risks. So as you know, any stock can go bankrupt, any stock could have issues or problems or new competitors, any bond could be attached to a company that has financial problems. So these are all have to be factored into your risk premium. So in addition to the risk premium, it's the length of maturity. So the shorter the bond, the less risky. So 3 month is less riskier than 6 month, than 1 year, than 3 year, than 10 year. So in the 30-year Treasury bonds are the riskiest. So the time frame, because that means this is the length of time before the bond will be completely paid back. So the bigger the time frame for any bond, the more unpredictable variables can occur during that time frame. And of course, if you're talking about a particular industry or company, there's risks associated directly with those companies. So if we were talking about Apple, the risk associated with Apple is that someone comes out with a better type of phone, a more innovative phone, a more innovative operating system. Someone comes out with a better computer. These are all risks to Apple. All right. Now, if we're looking at periods of return, a holding period is a period at which you actually, the period that you want to measure as far as your returns. It could be a month, it could be a year, 5 years. So your holding period, you determine the period of time at which you want to look at and measure. And there's two types of return, a realized return and a paper return. The difference is the realized return is you actually traded the security and officially realize the return and have to pay taxes on it. A paper return is sort of like you own a stock. I bought Facebook at 35, it's now 60, so I have a $25 paper return. It's not realized until I actually sell my position in Facebook, then I have the realized return. But the paper return is sort of the returns you have that are not they're still able to change because you have not closed the positions. So no sale has taken place. So a lot of people can talk a big game up about their paper returns, but it's really the realized returns at the end of the year that matter the most. And the basic formula for this, and we'll be doing some of these formulas next week in class. Income, which would be dividends during the period plus any capital gains, divided by the beginning investment. So capital gains, of course, is the beginning investment the ending investment minus the beginning investment. So $15 minus $10 gives me a capital gain of $5. If I had $1 of dividends, I'd have a $6 of income divided by, say, the beginning value, which I think I said is 10, give me a 60% return. So this is just a very basic formula that many of the other formulas are built upon to give us a percentile return. All right, let's go to another slide. So the advantages of this holding period return is it's very easy to calculate and understand, and considers growth and income. The disadvantages is there's no factor for time value of money. So you're getting a return over 10 years, but you're not backing out the inflation rate. So the time value of money is not a factor. And the rate, some of the rates can be inaccurate if the period is longer than a year because of this weighted averaging of the returns and the compounding. So there's definitely disadvantages of that type of system. All right. Okay, so I'm going to stop the lecture here, and this will be part 1. We'll continue with part 2 on Monday.